All righty, guys. It is another beautiful Sunday that we got here. And gives people just a second to join in here. We got a lot to talk about. That is for sure. This last week in the markets were things are looking a little frothy out there. Well, frothy not in the sense on the high side of things, but definitely we saw some heavy selling last week. I'm sure that like I can even kind of tell, especially when I see X. So like I've been doing this for quite a few years now, and I've really been able to pick up on like how the cycles really work and how they really move. More importantly, the behavior of different market participants during certain type of cycles. What's going on, Sam? Yeah, it's really interesting that when I actually see like a lot of the commentary on the posts that I have, or when I start seeing a specific type of news flow, whether it's going to be bullish or bearish, um, it seems to happen the most during extreme moments. So back in February, I ended up talking to a lot of the Savvy Trader group that I have, full of investors. And I said that right now we were at an extreme. And from my perspective, I thought that we were at an extreme with the AI hype euphoria. But now what I'm seeing here is I'm seeing an unwinding of that extreme. And now, hopefully, I think expectations should be a little bit more tempered. And if you guys ended up tuning in, not to probably, let's say, 3 or 4 weeks ago, I dedicated an entire Sunday live stream talking specifically about parabolic charts. Parabolic charts. I pulled up one of NVIDIA and I pulled up one of SMCI, and I said, you got to call a spade a spade. And this is something that I ended up learning in 2020, because I ended up going through that market cycle too. So 2020 to 2021, a parabolic chart was a parabolic chart. There was really no other way you got to call a spade, and you got to know exactly like what is risky and what is not. And for me, from my historical experience, I haven't been in the market since 1999. I was like 8 years old, so I'm 33 right now. But so I wasn't around the dot-com bubble, but I was definitely around this last bubble, which I that's exactly what it was in 2020 and 2021. That was definitely a bubble. And it was one of the most valuable learning experiences, I think, that of Finex's life. But it gives us a good idea of what not to do in the future. And that's exactly what I like to think of it as. So like when we do see those charts, when we do see the euphoria, and here's the interesting thing too. I thought this was really interesting, is that I do think that retail and individual investors do, and they are aware of this. So I feel like I'm almost preaching to the choir right now, that I think that that's the biggest difference that I see right now compared to 2020 and 2021, is that I do think individual investors are aware. And they do know, like what to stay away from, and they are buying the dips, and they are adding when things are a little bit cheaper. They're paying attention to valuation. But what I'm seeing here is I'm seeing the institutions doing the same crap that institutions are always doing. Basically, for example, like SMCI, and I was actually going to show this chart to you guys. So let's just jump right into it. We'll talk about that here in just a second, but I want to talk specifically about SMCI. So what I ended up doing is I ended up posting on Friday, and I said, look no further than NVIDIA and SMCI for the psychology behind institutional fund managers. And I know that I got some institutional fund managers that follow me right now, but they know it, right? So like, what I mean by that is that they do have a tendency to chase, and they do have a tendency to sell because they have to basically think about it like this. Imagine if you guys were running money for somebody else. You have to justify to a client as to why you're not holding a specific stock or why you're holding a specific stock. So like, let's say your fund. So like right now I'm underperforming the market on a year-to-date basis. In the grand total of things, I'm still outperforming, but on the year-to-date basis, I'm underperforming. I don't necessarily need to explain to individual clients and say like, yeah, I think that buying Snowflake right here is a great idea, despite Snowflake being down. Or even like Tesla. And I like for me, I have the opportunity to be able to think longer term, and I have the opportunity to buy when others are, like not wanting that individual company. But institutional fund managers, they don't have that luxury. What they have to do is they have to make sure that they're performing in line with the indexes or better in the shorter term. And if they don't, then essentially they end up losing that client, or they experience outflows. So this is a big way to like understand. This is really important to understand like how fund managers are thinking. So what you end up getting is you get these market extremes, and sometimes you see stocks and they go through these parabolic tops, and then they also go through just really overwhelmingly pessimistic sell-offs. And that's exactly what we're seeing right here. Is that at first, and what I noticed in February and March is that AI stocks, data infrastructure stocks, they were going through that type of hype cycle, and then we were at the peak of the hype cycle. And like right now, and it is just the most unusual thing, but I'm seeing all high beta and growth stocks sell off. So let's actually get back into exactly what I was going to talk about here today. More specifically, I want to talk about the market cycle, right? And how we've seen this 1,000,001 times before, and how we're going to continue to see this for as long as we do participate in the stock market. So this is a stage analysis, and traders use this quite a bit. For me as an investor, because I consider myself an investor, even though I understand trading really well. I like the stage analysis, and it really gives a good visual representation of like what we can expect from certain cycles, certain sectors, and certain stocks. So like what you can actually see is when we pull up the S&P 500 here. So pull up the S&P 500, and you can actually see on a shorter time frame that you do have that markup phase, and then you have that distribution phase, and now we're in the markdown phase. So going back to here, so the different stages of a market cycle, you can see that markup phase, the stage 3, and the stage 4. Now we're entering in the stage 4 in the S&P 500. But this is, so like I had a really good mentor when I first started, and he said, breathe in, breathe out. That's how the stock market works. And that always goes in the back of my head, because when you actually look at the markets over a prolonged period of time, over the past 100 years, there's periods of time where the market gets overextended, then periods of time when the markets go down. And even though nobody likes to see their stock market portfolio go down, for me, it does get uncomfortable. Like that's real freaking talk, man. Like no stock market investor ever says like, hey, I actually want to see my portfolio go down. Like if they actually say that, they're lying to you, right? I know that I really enjoy buying companies. Like I like it when stock prices go down from that end, because then I have the cash that I do have on the side. It gives me an opportunity to actually put that to work. But I don't necessarily like seeing my equity curve go down, because then your net worth goes down. And then, of course, since I publicly share my portfolio, then sometimes I have to explain myself like, hey, right now stock prices are going down because stock prices are going down. That's the only explanation that I really do have. But that's really the name of the game. Remember, like how I ended up mentioning, breathe in, breathe out. There's stages of a market cycle where you do have that market uptrend, and then you have a market downtrend. And making sure that you pay attention and understand exactly like where things are going is basically the name of the game. And that's what I really, really like to talk about with you guys. And that's like the whole reason why I talk about this every single Sunday, is because I don't think that anybody really focuses on cycles. But let's talk about this existing cycle right here. The whole reason why stocks ended up selling off in the first place. So like, it's really important to understand like how this year has really shaped out, how the narrative has evolved too. So in the beginning part of the year, we had that AI like hype cycle. Software stocks were even ripping. And there was a point in time back in like, let's say early to mid-February. And I know this because I follow my equity curve, but like right at the peak of my equity curve, I do remember getting really anxious. And I was thinking to myself, I was like, my gosh, like this is actually a really troubling time, because stock prices started getting high. But we got to look back at what the narrative was. So the narrative was, oh, the Federal Reserve is going to cut rates, like inflation is coming down. Like that was the whole narrative. People got really excited, and they essentially front run the Fed. And now, and it's April 21st. So it's like 2 months later, which is just the craziest thing. And it's just the craziest thing to me. Now, what we do is we actually are favored. So we're favored to get at least one rate cut at the moment. This is December, right? But we're still seeing a rise, and I actually can scroll down here and I can show you guys. We're still seeing that rise from exactly where we were. So just 1 month ago, we had a 0.5% chance of our rates staying about the same. Now we're at about 13.1%. And now we used to be about a 5.2% chance of one rate cut. Now we're at about a 37.2% chance. So essentially the evolution of the narrative here, what it's basically done is we went from pricing in about 4 or 6 rate cuts to now basically pricing in maybe 1, maybe 2 rate cuts this year on a favorable basis. We could even like I actually think I saw last week, and I think they priced it out of the markets, but now there's even talk about a rate hike, right? And this only took about 2 months to evolve. And the macro data, it just slightly it didn't favor, from an inflationary perspective, it didn't favor rate cuts. So then all of a sudden, what we saw is we saw this extreme selling in high duration stocks, and then now basically there's no more rate cuts priced into the markets, and it's just like this is just madness. Like there's no other way to say it. So like when I'm looking at these charts here, so like let's go back to the S&P 500. You know, at the in February timeframe, it was just absolutely wild to see like all these stocks just fly, and people were saying that there's gonna be 4 to 6 rate cuts, and then now we're on the complete opposite end of that. And now for me, I'm thinking to myself, I'm like, I don't think there's enough rate cuts priced in. I think that's what a lot of investors are thinking. So it's just like we went from one extreme to the next over the course of about 2 months. But more or less, this is pretty much what I think that the market is actually going to shake out to look like. So if we look at the S&P 500, and I actually have the NASDAQ pulled up here too. The reason why I think this is I don't know if we're going to actually hit this black line right here. I think we're more likely to see something like this. I actually have an Elliott wave pattern pulled up. So I want to show this, and this is actually going to be on my YouTube thumbnail. So the reason why I'm not super like anxious to buy the dip right now, and I'm seeing a lot of people do this. So usually stock market corrections work in like an Elliott wave manner. So like, let me show this right here. There we go. This is basically what I'm talking on. Yep. Thanks, Sam. You just sent me a message. So usually stock market corrections work in an ABC pattern. This is what I really learned when I was brand new. And I didn't quite fully understand it. So I'm going to just take just a second here to talk on this. So what we can see is in the Elliott wave is a real thing, and stock markets usually, yes, I think so. Sam just said, so I get comments for both X and YouTube, and he says he thinks we're probably at A. That's exactly what I'm thinking right now. I think we're on the initial downward move. So like, let's go back to the S&P 500, and I'll show you guys more of what I'm talking about here. So as we go back to the stock market correction that ended up happening here in the June-July timeframe, we had our A wave down, B wave, C wave, and then this is a 5-wave pattern here. So I think it's actually more, you're going to see it better on the daily chart. So let's switch over to the daily chart here real quick. So you can see that 5-wave pattern down, A, B, C, and then I don't know what you want to call that. Like a 5, yeah, so 1, 2, 3, 4, 5. 5 waves down. And that essentially, when that 5th wave happened, and when we hit that oversold conditions, I knew, because I understand very basic Elliott wave analysis of saying like, this is probably a good time to buy stocks like right here in this area. So I bought stocks on the 3rd wave down and the 5th wave down. And so now let's go back to this initial correction right now. So at the moment, I believe that this is a wave down. And I do think that this has the potential to probably be some sort of like ABC move. I think it's going to be a 3-wave move. And I do think that what we're going to do is we're going to actually come back and we're going to retest these initial highs. So you can see the reason why I think this is really two reasons. So we're zooming out. This is still the daily chart, so I have to go out just a little ways. This is the previous high back in December of 2021. So the way that I've really realized that support works, and from a technical perspective in the stock market, and I rarely use technical analysis on on individual stocks, but I do realize, so like you can even see right here that the markets really do respect the technicals in a very big way. So like the 200-week moving average is usually a really strong support. 200-day moving average is usually a strong support. That's in the stock market. And that's because that's pretty much what institutions are following. So what I think that we're actually going to come back. We're going to test this previous breakout. So I could see the entire year-to-date gains on the S&P 500 completely wiped out and coming back into the 200-day moving average. Which I know that some people, when I talked about that, some people were thinking to themselves, they were like, "Oh, there's no way it's not going to come back into the 200-day moving average." And it's like, well, when you look at the stock market, it's actually really normal and it's really healthy to see the stock market come back into its 200-day moving average. So like when we go and we zoom out, so like, and this is a very unhealthy market cycle from 2020 to 2021, back half of 2021. We didn't touch the 200-day moving average until we basically broke down and came back into that 200-week moving average. But if you go back into previous cycles, so this blue line is that 200-day moving average. Like in 2019, it touched the 200-day basically twice, but it looked like it almost touched it right here too. 2018, touched the 200-day moving average. And then you can even go back here, and it's just like there's countless times where the 200-day moving average is consistently remet. So there's really nothing wrong about the stock market coming back into the 200-day moving average. It's probably indicative more of a really healthy bull market, honestly. So like this. Let's go back to exactly that support line here. So we got a confluence of support from the structural high. So like the previous breakout. So this is now a line of support that just because of a structural perspective. And you can see that the market even came up here and touched this, bounced around, and then eventually broke out, right? So I think that the S&P 500 is going to come back in here and then actually come back into this 200-day moving average. And these two should line up at about the same time. It would not surprise me to see this probably like early June timeframe is when we're thinking maybe late May, early June. I do think in the short one, we're probably going to see something more like this. We're probably going to get a bounce either this week or next week on earnings or better than expected results or whatever. I don't know. There's going to be some sort of narrative that's going to be painted. And I do believe that we're going to see that A, B, C down. So it should look something like this. That's a really pathetic green line that I got there. Let's try to paint this again. So I do think it's going to look something like this. There we go. Oh, it was dotted. That's why. So let's make this a solid line. And I do think it's going to be 1, 2, 3, and then we're going to come back into the 200-day moving average, and that's going to be my buy zone. That's essentially what I'm thinking about from that perspective, and that's like where I want to actually load the boat, because I do think that zone right there is going to be the full year lows. So I think that's going to be like the year-to-date lows, and that's going to be very important to actually set a portfolio up to position or to outperform on a full year-to-date basis. I don't think that it's a good time to sell. I think that in February was a good time to sell for a lot of companies. I mean, SMCI is already down like 20% on Friday alone. Oh my gosh, NVIDIA, I just totally drawn a blank there. NVIDIA was down like 10%. So the cycle is already beginning. So the down cycle is already beginning. I mean, I actually have like 5 stocks I'm going to throw on your guys' radar here at the end of this video. But I want to make sure that I'm showing you guys another chart here. The NASDAQ. So the NASDAQ, there's a couple lines of support here too that I think that we're going to come back into. I got to make sure that I'm sharing my screen. All right, I am. So the NASDAQ, I think that this is going to follow a similar pattern as the S&P 500. I could see something like this here this week or maybe next week. And I think that we're going to actually I think we're going to undercut the lows. And I think we're going to come back into like this area. So I think that we could be near the lows for the NASDAQ. It depends on how NVIDIA is going to trade and a lot of those other big caps. So I think that it could probably look something like this. And then you can actually see the 200-day moving average. That's the existing trend. And I think that the NASDAQ will come in to its 200-day moving average. If not, it will come down to this little support right here. And if that's the case, then we could continue to see a further flush out this week. If we don't bounce this week, and the reason why I think that, let me actually show you guys the daily chart here. So the reason why I think that is that the daily chart right now is actually signaling that we're oversold. So the RSI is actually hitting that oversold conditions. So that makes me believe that we're probably positioned for what could be a bounce. And then I do think we're going to get that last flush down into the 200-day moving average. It could be something like this. Like we could moderately undercut the 200-day, just like how we ended up doing right here, moderately undercut it and actually hit that structural support zone right here. And it could even be like right here. So it's going to be, let's just say that we have a downside target on the NASDAQ of like 14,470 to 14,750. Let's call it 14,750. That's really how I think that the markets are going to end up trading. And I do think they're going to trade into like another, hold on, I got to read a lot of mega cap tech companies bottomed in August last fall, but market bottomed in October. Yeah. And I could see a lot of tech stocks. And I'm actually going to show you guys that how I'm looking at a lot of the valuations right now with a lot of these tech stocks that it's really, I mean, this has been a really weird cycle. This cycle actually reminds me a lot of like late 2021 and early 2022, where the NASDAQ peaked in like November. And then we saw like a lot of the underneath breadth, and I'm actually going to show you guys the market breadth here in a second. We saw a lot of the breadth in the markets really start being really weak, and like that, I think it was like November 14th is what it ended up being. And then we saw the markets, the S&P 500 specifically, like peak in January of 2022. So it was like 2 months later that we saw that. And that's exactly what this market cycle is really reminding me of when it like today is that we're seeing a lot of high beta stocks sell off. And we've seen a lot of high beta stocks sell off since February. And now we're just starting to see the market come down. I'm not sure if that's going to be a really terrible thing or if that's just like, hey, a lot of these high beta stocks, they lead markets up and they lead markets down. I'm kind of leaning there towards that. This is another reason why I think that the markets aren't really bottomed at the moment. And I do think so. Like going back to what Sam ended up saying is that he said mega cap tech companies bottomed in like a couple months before. So like in August when the markets bottomed in October. What I'm actually thinking here is I think that a lot of smaller cap companies are going to bottom. So if we go back to 2022's bear market, if you guys can remember, small cap, high beta stocks. So like a lot of the stocks that I own, they bottomed actually in May and June of 2022. And then they basically traded up and then traded down and traded up and traded down. So they basically followed like this support line. There's no chart. There's no better chart to show this than Snowflake. So I can actually show you guys this. So you can see that in 2022's bear market, so Snowflake ended up bottoming in that June of 2022 timeframe, and it traded like this sideways price action. And now we're actually coming back into that zone. That's what I saw from a lot of companies back then. I think that that's what we're going to go through now. Is I think that it's still going to be super volatile, but I do think a lot of high beta stocks are actually bottoming out here. That's just from my perspective, but I do want to go back to this market breadth. So like I've seen so on X, I've saw about like 3 or 4 different charts just today when I was scrolling through, and they talked about how they think that markets are bottom because of like the McClellan oscillator. If I'm not right on that, don't hate me for that. But then also like the percentage of stocks trading above their 50-day moving average in the S&P 500. I really like this chart because this chart is super accurate when it comes down to figuring out exactly when markets are going to bottom. And what I've noticed here is that once we get underneath that 25 to 20% of NASDAQ stocks trading below their 200-day moving average, that's how you know things are getting really panicky. That's usually indicative of a market bottom. And you can see that right now we're at about 38.61% of stocks trading above that 200-day moving average. So yes, it's not, we went from, so like this doesn't really do it justice. We went from 50 to 38. So that's actually quite a few companies now trading below that 200-day moving average. So we're definitely seeing a deterioration in breadth. But if we do go down further, which I think that we might, like I said, I think we're going to get that ABC down. I do think that we're going to hit like below that 25%. And it's really important to say before I keep talking about this, I really don't think that this is a stock market crash. I know that I'm seeing a lot of commentary right now about, so like, especially from Meet Kevin, who's just constantly like, and I love that guy. I really do. I got absolute respect for him. So I'm not trying to talk crap about him, but he's gone like full bear. And I see a lot of people go full bearish right now. And that doesn't make sense to me because this is 2022 and repeat. So like we really went through the heavy market cycle, the really nasty market cycle in 2022. But now we're getting like a mini 2022, which is why we're seeing XLE run. So like if you guys, I don't know if you guys tuned in about 2 weeks ago when I talked about when we did intermarket analysis, we took a look at a lot of the commodity prices, XLE, the consumer staples, XLP. But we saw that these were the companies, or these sectors were the ones that were outperforming, which are usually the sectors that outperform at market peaks. And we're seeing that again this year, where XLE is now outperforming on a year-to-date basis and still staying relatively resilient. Obviously we have a lot of the narratives around geopolitics and et cetera, et cetera. But this is usually this is almost an exact playbook from 2022. And because it's an exact playbook from 2022, it reminds me so much of like the COVID hysteria, where we had the COVID playbook, the stay-at-home stocks, if you guys can remember that one. That's exactly what my mind ends up going to, where we had like this vaccine news and then no vaccine news and bad COVID and then good COVID and all that other stuff. And every single news headline that we ended up seeing, we saw like a reversion back to the playbook. And that's what I think exactly is going on right now, is that a lot of fund managers and institutions and big money, they're going back to the inflationary bear market playbook. Yields up, inflation's up, XLE's up, high beta stocks down. Like this is exactly what this reminds me of. And I do think that this, because it's it's like a copy paste of 2022's cycle. I don't think that we're going to get the same result as 2022, which is that devastating bear market. I really do think that this is going to be something that's a little bit more of like a corrective pattern, which is okay. You know, like 8 to 10% down at the most is really what I'm thinking here. Okay, let's. I want to go into actually earnings. So just to recap a little bit right here, we ended up talking about the market, and like I do think, let's go back to this S&P 500 just to rehash like exactly. So I want to be concise here. We got a downside price target on the S&P 500 about 4,800. Yes, the S&P 500, that's the index, not the SPY. So 4,800 on the S&P 500. I think that this is the initial wave down. I think we're going to get one bounce either this week or next week, and then we're going to get another wave down. That's where people are going to start getting a little panicky. I think that this is going to be the opportune time to buy. Once the S&P 500 hits that 200-day moving average, that's our zone. That's what I'm going to be shooting for here. The NASDAQ, I think that we got something similar that's going to happen. We had really aggressive selling this last week. RSI is oversold. I do think that we need a bounce. Like that bounce is going to happen. Like I said, this week or next week. But I do think we're going to undercut these previous lows on whatever headline. I think that stocks could even potentially go up on better than expected earnings. That would make a lot of sense to me. But right now, it's just like the narrative isn't different. Like we do need something to change in the macro. Once again, just like rehashing exactly what we're talking about. So like the reason why the markets are doing this right now is that if we, like in the beginning part of the year, we thought there was going to be 4 rate cuts. Now we're thinking that there's going to be 1 or none, and possibly even a rate hike. That's what a lot of people are saying, a lot of those fund managers, and they care about that stuff. And that's essentially what dictates the short-term direction of the markets. Is if we do get another bad inflation reading over the next couple of weeks, I do think that that's going to be the catalyst that will set us even lower, and that's okay. You know, like I do think that we're going to come back down into these zones, and this could even be like an inflation print, because what is that, May? Yeah, so over the next couple of weeks here, we could see an upward price action. People are probably going to get excited, and then maybe it could be a bad inflation print. Maybe it could be a bad jobs number. I don't know, anything. And then that's going to send us lower into that 200-day moving average. And what is that, like a 3 or 4% move down? So it's like, it's not a big deal. Okay, let's talk about earnings here. So this week we do have Tesla, and I do want to talk about Tesla. Right now, it's so core PCE is Friday. So yeah, I got a comment on YouTube from Sam. Core PCE is this Friday. Usually core PCE and PCE numbers are nothing burger, but it's not because the data isn't important. It's because economists are able to take the CPI and the PPI and combine those two together to be able to actually like predict with somewhat accurate estimates about what the PCE is going to be. So it's essentially like the move is already kind of out of the way on the CPI and the PPI data release. So that's why I think that PCE, it is important to pay attention to, but it's not like a game changer as much as like CPI and PPI usually is. Okay, we got to talk briefly about Tesla. And I don't want to make this a Tesla video, that's for sure. Because I don't know about you guys, but like my For You feed is basically all Tesla, and it's getting crazy. So I got to go on a mini rant here. Holy crap, people need to chill. Like there's no, like Tesla is a company, and I don't know why this company is so divisive. It doesn't make any sense. I know Elon Musk is a pretty divisive person, so maybe that's why. But like honestly, it's like either they're going to do good or they're going to do bad. And I think everybody already knows that this quarter is going to probably be a bad quarter. I think a lot of investors who do. So I own the stock because of autonomy and the long-term opportunity. And it's like we do see that major levels are being broken. And yes, obviously this is going to make any investor nervous. And every single investor who is holding the stock, it's like, yes, I mean, we're all watching it. I know for me, I'm looking at it and I'm like, man, this freaking company right now is down 40% year to date. It's killing me, right? And obviously that's real pain. And every investor is feeling that. And it's just like now we're seeing the bears come out in full force talking about how this company is going to zero. It's like, no, that's also not true. Like this company could potentially, it could sell down even further to like 135 zone. I don't know. I mean, or it could, or this could be the catalyst, these earnings that are going to come out. And that's really what I'm thinking of right now is that this earnings is there's so much bad news baked into these earnings. Like Tesla, I mean, like let's look, just briefly rehash the narrative. Tesla China is going to crap because of competition. Nobody wants EVs. Elon Musk is a whatever, super divisive. I don't even know all of them. I can't even list them all off because I don't think I could fit them on two of my hands. Basically, what I'm saying is that the sentiment is so bad for Tesla stock that if they just come in and just say margins are going to bottom for the rest of this year, or we're seeing accelerated revenue adoption from autonomous vehicles, or we are going to have the Model 2 and we're also going to have robotaxi. Like it could be something, anything. It could be something small, just something to give investors some sort of hope to increase the future expectations. And I think honestly, Tesla could just like how it has a million and one times before, it could act like a rocket ship because sentiment is so bad. And you could even look at the put option flow on Tesla, where it's people think this company is literally going to like $100 per share. And I actually saw a price target the other day, $85 per share on Tesla. Like, okay, I mean, I'll bite. That's fine. So now we're thinking that this is supposed to be valued as like a value stock, where it's just like we're going to completely ignore everything else. All right, that was my mini rant. I feel like I can keep going on this one. Basically, what I'm saying here is that the sentiment is so bad on Tesla that I do think that it's going to just take, it's like a powder keg. It's going to just take a little match to hit that gunpowder and it's going to explode. And it could be anything. And I think earnings is the perfect catalyst. So we're also going to get a lot of other data here this week on UPS. I do pay attention to UPS. The reason why I pay attention to that is it gives me a good idea of like what the consumer is doing and the consumer economy. I'm not super optimistic about the consumer right now. I know that people are going to be paying attention to Meta and Chipotle. Personally, I love Chipotle. I think I've ate there 4 times this week, so I'm pretty sure that I've contributed to the bottom line there, and so has my wife. But then we got Meta here. I think that Meta is probably going to – I mean, Meta's doing some really good stuff. And if I didn't – I don't know. Sometimes I look at that and I'm just kind of like, I really missed it. I really did believe that whole like TikTok news flow thing, that it was actually going to destroy Meta. And I believe that. And that's why I'm like looking at all this Tesla news and I'm like, man, this reminds me so much of Meta right now. Just because things got really, really pessimistic. Meta got down to $86 per share. It's like, what is it, 500 today? I don't know. It's somewhere up there. It's like $400 to $500 per share. I mean, people really go to the extremes with these companies. Okay, but we're going to get some really, I know they got a lot of great things working on, especially from AI. Pay attention to exactly what they're working on. I'm looking more towards Microsoft and Alphabet. Okay, so brief talk about Microsoft and Alphabet. So right now, what we know is that software stocks, especially data infrastructure stocks, are not in a good place. And this is actually, we can actually see that on Jam & Ball's recent article that he had, where we have that high growth software now trading down to about 8.6. Historically, high growth software names, like especially when they're free cash flow positive, trade at 10 plus. And we also have pretty poor expectations as far as it comes down to next 12 months revenue growth. I just got to make sure that I'm sharing my screen. Okay. So we actually see like Snowflake right now has 22% revenue growth expected. MongoDB, 14% revenue growth expected. This is way down from like 20 to 25% that we had just like 2 months ago. So this is a big deal. And the reason why this is a big deal is that we have Microsoft and Google's earnings coming out this week. And I thought for sure that Amazon was reporting earnings, but I'm not sure. I guess it's supposed to be next week, not this coming week, but the next week after that. I don't know. Let me know in the comments. But I do know that Google Cloud and Microsoft Azure are going to act as catalysts to software stocks. Like these software stocks will bottom if they come out better than expected, especially Microsoft Azure and especially AWS. If AWS and Microsoft Azure come out and they say, we're seeing better than expected results, we're going to increase our guidance for the year. I'm not sure if they give guidance. I don't think Microsoft gives guidance on a full year basis. No, they do. Sorry, they do. But if they come out and they expect better, or they're seeing a continued stabilization or net new rates or some sort of strength in cloud, I do think that a lot of these cloud names are going to act like rocket ships. Like right now, they are way down. So like not only is the valuation relatively compressed, but I do think that the next 12 months expectations are super compressed. So when I listen to MongoDB, and so MongoDB, for context, in 2022, so actually, no, at the beginning of 2023, they guided for 14 or 15% revenue growth on a full year basis. They grew 31%. So like, I see that again with MongoDB. I think that they came in and I think that they lowered guidance and they basically nerfed their guidance and they said, yeah, I think we're only going to grow 14, 15%. Basically setting the bar super low. And I think that a lot of these software companies like Snowflake said they're only going to grow 22% this year. But they ended up growing. They actually had their highest net new ads in like 6 quarters last quarter, or sorry, in Q4, I should say. Like, I'm not necessarily sure if I'm buying this. And they have like a lot of remaining performance obligations. Like, everything looked great, but the guidance was really crappy. I think that they actually set the bar super low. And I think MongoDB did too. And I think a lot of these software stocks actually set the bar really low so that it makes it easier for them to be able to hit it throughout this year. I'm not 100% sure, but like, if I had to give it odds, I'd say like 60 or 70% sure that that's how this year is going to shake out when it comes down to software stocks. So like the multiple doesn't look super great right now, or it actually looks great depending on who you ask. So right now the multiple in the market in general, it's trading really low. The next 12 months expectations is really low. This basically sets us up for a really, really great earnings season. Now, what I am concerned about is I'm concerned about large cap stocks and not all large cap stocks. One large cap stock in particular, I'm really concerned about NVIDIA. Now, hear me out. This isn't going to be an NVIDIA bashing. I think it's a great company. I think that what Jensen Huang, I love Jensen Huang. Like, I think that I think what they're doing is next to incredible. But when I look at the stock chart, I do believe that institutions and fund managers got way ahead of themselves. And I think that that's reasonable to say. I could actually see it coming back down in this 400 area because there's really this is just a parabolic move up. I mean, sure, NVIDIA can come out, beat, like triple beat, right? So they could beat EPS, beat revenue, and raise on all accord. Like they could absolutely do that in the next coming weeks when they report earnings. But right now, what I'm seeing here from a technical perspective is that this is a big gap that needs to be filled. So this is a giant gap fill. And right now that was a big doozy of a candle. And I think that like when I look at NVIDIA, I'm really concerned about like people. And I know about two major financial influencers that bought up here. And I'm like, guys, did you not learn anything in 2020? And it's like, or 2021, it's like, you don't buy them when they're 50% or 100%. Like look at the 200-week moving average. What is it, 268? So what is that? Like 3 times above its 200-week moving average? Like, oh my gosh. Some people are never going to learn. That's fine. So I do think I'm really concerned about NVIDIA's stock price. The business is going to be great long term. So I'm not bearish on NVIDIA as a business, but I do think that that's actually going to play a role into how this is going to shake out, this mega cap forward PE, and I do think that it's going to play a role into how the S&P 500 trades too. I just keep looking at this divergence between small caps, mid caps, and large caps, and I can't help but consistently come back to it in my head that there has to be some sort of, it has to come together. It always does. So like even back here in the early 2000s, so late 1990s, early 2000s was the last time we had this massive, this big of a divergence. And of course, what ended up happening is the NASDAQ bubble did pop. And I don't think that we're in a bubble, so I'm not calling it a bubble. The NASDAQ bubble did pop, and we did see that confluence, the confluence of like this, because right now from like 2012 to 2016, small caps and mid caps, historically, they grow faster than large caps, which is why you see it trading at a slightly higher valuation. But over the past couple of years, since the end of the bull market in 2021, what we've seen is we saw small caps and mid caps absolutely get shot, and now we're still seeing them trade at depressed valuations. Where I do think that at the moment, like it makes a lot of sense to actually see small caps and mid caps consistently like outperform the major indexes. I don't know. I feel like when I'm saying it, I feel like I sound crazy, and I know that. But it's just like historical norms, and trend has to revert. And I want to talk briefly about SMCI too. So SMCI and NVIDIA are somewhat correlated. And I think that Eric from Fired Up Wealth, he did say that SMCI is not a semiconductor stock. It's not a semiconductor stock, guys. Like, I don't know who thinks it's a semiconductor stock, but they provide the equipment to put into data centers. They don't make anything. They don't make any semiconductors whatsoever. We're seeing this MACD curl over on a weekly basis. We're actually seeing the RSI come over. Now it's coming down from overbought conditions. And this is a parabolic move up, and this is a gigantic gap that needs to be filled. I don't know what the real forward PE is on this company. So I think I talked briefly about this one time. When we think about like how analysts' expectations, like how this even happens in the first place. I've seen this happen for years, where analysts, they'll chase stocks up and they'll crush stocks on the way down. So as stocks are selling off, they'll continuously lower their guidance. They're doing it to Tesla right now. And they consistently say like, oh, well, I think that this is going to happen. I think this is going to happen. And then they consistently lower their next 12 months expectations. And then this makes the stock look overvalued. Meta did this in 2022, where a lot of these analysts, they came out and they said, yeah, I think Meta's only going to grow like 5% this year or 10% this year. And they're growing 25% right now, I think is what they're expected to do in revenue growth. That's nuts, right? So like, but analysts thought they were only going to grow like 5 or 10%. And now that's why forward PE is so hard. It's a moving target. That's what I think is happening with NVIDIA. And that's what I think is happening with SMCI is like, if you look at their 2025 their 2025 estimates, not super crazy. I think that they're actually like double digit. So like 15, 16% growth or whatever it might end up being. This is just totally off the top of my head. So you guys are gonna have to double check my math here. But it's this year that they're thinking is they're actually going to see massive acceleration. So like NVIDIA has like, I think at the top had like 82% growth expected for this year. So like what happens if that 82% growth is a lot more like 40% growth, right? And that's essentially where that stock price needs to normalize, is the next 12 months expectations needs to normalize into a lot more of a reasonable, because these analysts, they kept on shoving up their targets or their price targets. And they kept on saying, oh, I think they're actually going to do 40% growth this year, 50% growth this year, 80% growth this year. And that's essentially what ended up happening with NVIDIA and SMCI. So like when people say, oh, the stock is cheaper now, it's like, is it? Or do analysts just chase the stock up and then chase the stock down? I think I'm betting on that one because I've seen it happen 1,000,001 times, and investors are wise to know that that's exactly what they do. But I do think that there's a couple major opportunities in the markets here today. I'm going to throw 5 stocks on your guys' radar right now. And the reason why I'm going to talk on Amazon first. So Amazon is going to be set to report earnings not this week, but next week, I think. Correct me if I'm wrong. Comment down below if they are reporting this week. When Amazon reports earnings, I do think that there's going to be a major push for software stocks. I really do. So like a lot of these companies, they're, like I mentioned before, just briefly, I don't want to repeat myself too much, but their next 12 months growth expectations are extremely low. Snowflake is expected to grow 22%. I could see them growing 30 or 35% this year. Honestly, I really could, knowing what I know about the business. And if they do, I mean, we're going to go back to recent highs, to new 52-week highs. So Snowflake, I do think, and you guys can actually, what I actually wanted to do here too, is I pulled this up on finchat.io, and you can actually see like the next 12 months EV sales ratio. And you can see how it's traded historically and how it's trading at a really low valuation right now. So you guys can actually see, so this is new. Oh yeah, right here, forward EV to sales. And you can see that right now it's trading pretty low. I got the second stock here for you guys. Not Amazon. I think the MongoDB is a great buy right now. I really do. MongoDB, like I said, in 2023, they said that they were going to grow 14, 15%. They grew 31% in 2023. And that's what they did. So like right here in this area, they said, so it was like February, March, they said, yeah, we're probably going to go, 15% this full year. They came out and they destroyed earnings expectations all year. And then the stock flew all year. And now we're here again. And now we're here trading at a place where it's like, now it's the 200-week moving average. It's trading at a line of support. So you can see it's retesting those recent lows. Now it could go lower. And I do think that these, the mega cap tech stocks like Microsoft, Google, and Amazon, I do think that these have a very, very strong potential to put in the bottom for these data, like these data infrastructure software stocks. The third company that I think is trading at, guys, I can't pound the table hard enough on Mercado Libre right now. So like I want to show you guys the valuation here. So I'm pulling it up on finchat.io at the moment, but this is just I'm kind of winging this. But okay, so Mercado Libre is trading almost down to its 200-week moving average, and from my perspective, I do think that Mercado Libre, when it's trading down at its 200-week moving average, that is a buy zone. Okay, so you guys can actually see, and I got its next 12 months EV to sales. So it's EV to EBITDA. So it's EBITDA margin. Now it's actually trading, and it kind of went wonky here for these years. So let me just adjust this. Okay, now you guys can actually kind of see that right now. So Mercado Libre is actually trading at a pretty low valuation relative to its historical norms. So we can see that, and its revenue growth rate is actually accelerating from the previous year. So like in 2023. So like usually it wants to trade around 24, 25, 26. So like, because we got some 30s over here, we got some 27s over here, and now it's trading at like 20.9. Not only that, but we can actually go back to the chart here too from the technical picture. Sorry, this is MongoDB. We got to go to Mercado Libre. Okay, so we got the technical picture here. We got like a structural support zone right at this 200-week moving average. And I do think that we're actually going to hit that 200-week moving average on Mercado Libre. But I want to throw that one on your guys' radar because I do think Meli is going to continue to outperform. This company is like the most steadiest of eddies that I've ever seen in my life. I mean, they come out consistently year after year, quarter after quarter. They beat results, they beat revenue, they beat earnings. They continue to expand their bottom line. They continue to develop their moat. I mean, Amazon doesn't even want to compete in LatAm because of Mercado Libre. Like, I don't know what else more this company has to do to gain investors' trust. And right now, it's actually trading at a relatively cheap valuation at a forward multiple of 20 EV to EBITDA, which I think is so. It's basically trading at a 20x EBITDA multiple. I mean, I can't beat the table enough on this one. Okay, so I actually have a new stock here too that I wanted to show you guys, and this is going to be Samsara. Samsara, I did a lot of research on this company, and I want to buy this company really bad, and I have actually. So it's at about a 1.5% position. It's a new position for me, and I did a little research on this, and I'm going to share just briefly what I figured out about Samsara. Man, my mouth gets so damn dry. Okay, so Samsara, what it is, it's actually a software company, right? And it's from these guys. They originally started this company called Meraki that was bought out by Cisco. But what they ended up doing is they basically made this company that has Internet of Things, right? So like little devices that attach to equipment. And what they can do is they can even do like, it's not even just like monitoring the equipment, but they can actually like monitor their drivers. Let me cut to the chase. What they basically do is they help big industrial companies, and they say like this consists of like 40% of all GDP. Big industrial companies streamline their operations, and they give them the data and the insights that they need to improve their safety outcomes and then also improve their bottom line outcomes. So now these companies are actually more profitable because they're using a company like Samsara. Because they know where all the equipment is at any given point in time, or like what what their technicians are doing when they're making calls. I mean, like, just going to throw this one on your guys' radar. I do think Samsara, and I've overlooked this company. I looked at it at IPO, and I'm like, oh, screw this, man. I think they were doing like 60% of the revenue was software revenue back then. Now it's about 90%, 95%, which provides a really good visualization at exactly what their full year revenue is going to be. So they're guiding for about 30% revenue growth this year, which is definitely on the high end compared to the other software companies at the moment. So Samsara, I think, is going to be one that's definitely on my accumulation target. From a technical perspective, we can see that it's actually coming back down into this cup and handle. This is definitely a cup and handle. Now it's coming back into the structural support zone. I do think it could potentially touch 28.87. The valuation is high right now, but what I like to point this out is that there's two different multiples that I like to pay attention to when it comes down to software stocks. First one is going to be next 12 months EV to sales. And then the second one is actually going to be the 2025 EV to revenue. So like right now we're about halfway through the year. And at the moment, there's certain growth that's priced into certain companies. So you can see that even though Snowflake has a lower next 12 months EV to sales than Samsara, you can see that they're about the same. I mean, they're only 0.2 points off from each other on a 2025 revenue perspective. And I do think that Samsara is going to exceed guidance that they ended up giving this year. Just basically listening to investor conferences, listening to the investor calls, seems like that there is some sort of conservatism baked into these guidance, and they do have a lot of visibility into their revenue. So I think that's one company I want to throw on you guys' radar there too. And the second one is going to be Kava. I researched this stock for like an entire weekend here. Gotta make sure I'm sharing my screen. Okay, I am sharing my screen. So like Kava right now, it's a brand new IPO. Long story short, what these guys do is they basically, oh, thanks, Sam. Sam said that he's a big fan of Melly. Mercado Libre, guys. Pound. Okay, I'm never going to do that again. I got like 600 people watching right now, and I'm just, oh my gosh. Hey, screw it, right? When in Rome. But I do think Mercado Libre is definitely a pound the table. That's what I was doing. I was pounding the table, by the way. Mercado Libre is definitely a pound the table. Okay, so Kava, basically, what they do is they do a Chipotle-style restaurant there, but it's Mediterranean. When you look at, so like and we don't have one here in Minnesota. So if you guys see a Kava, try it. And if you guys like it, let me know. Let me know in the comments. And I think that this is they have the opportunity. They're supposed to grow like 50 restaurants this year. They're supposed to have like around 20 or 30% revenue growth this year. A lot of room for outperformance. A lot of people say that their growth slowed down, and that's why they wanted to sell the stock or why they're bearish on the stock. And it's just like, if they really understood the story, what they did is they acquired a company previously, and they were basically absorbing that company, which artificially accelerated their revenue growth. And now things are a lot more organic. They probably could do some acquisitions if they wanted to do some acquisitions. But right now they have like basically, what is it, $400 million? This is off the top of my head. $400 million in cash, no debt. They are just transitioning to GAAP profitability, and they are free cash flow positive too. I mean, like, this is definitely a company, brand new IPO, that I think has the opportunity to really outperform. And the technical picture looks amazing. This is clearly a cup and handle coming back into that previous breakout zone. And for me, from this perspective right here, I think that this has the chance to really be a long-term winner, especially if they can scale to that 1,000 restaurant mark. Right now, they have about 309 restaurants in just the United States. If they can get to that 1,000 restaurant mark, I mean, we're looking at like a 25% compound, probably compounded returns over the next couple, let's say 4 or 5 years is what I'm thinking for Kava. Okay, so I think that that's all I got for you tonight, guys. Let me know what you guys think down in the comments. If there's anything else that you want me to cover during these live streams. Obviously, I'm going to see you guys again here next week. Remember, everything is a cycle. That means that as we see this news flow come and go, people are going to be overwhelmingly optimistic and people are going to be overwhelmingly bearish based on what the market is doing, and not necessarily because that's reality. All that matters is the company's price that you are paying at, and then also how they perform and actually might need to zoom out. Those biceps are taking up most. Okay, thanks, man. All right, guys. That's probably where I'm going to leave it off at. Until next week, of course, you stay classy.